Hey guys, it's Max. How's everybody doing? Appreciate y'all for being here. I didn't publicize this live stream in advance. I'm basically just trying to record a video. I'm just doing it live. So I don't want to have to edit it. But we're going to do a few back tests. But first, let's check in on the market. I mean, the market's moving. It's noon. This is live. So, I mean, heck, the SPY is it's in the same range as yesterday. I don't get excited, or I get more excited when it gets outside of yesterday's range, when it gets either above yesterday's high or below yesterday's low. But in any event, so right now it's grinding within the previous day's range. That's fine. At least this bullish gap is staying open. It's good news for bears. It hasn't gone and closed this gap or something. So anyway, all right. So real quick, let's look at Alti. We looked this morning, but nothing was really moving yet. So we'll check out the Altiverse, the Alti grid. We'll just go straight to the Altiverse. Okay. This SYM is amazing, up 20%. All right. Alti's up 1/3 of a point. Average stock's up 1 1/3 of a point. Looks pretty good. mRNA, of course, killing us. LFGY. Let's go see what's going on with the LFGY verse. So I forgot if they got their own page. Yes, they did. So look at this. This looks pretty good. LFGY up 1%. The average up 1.2. That's nice. Hope I remember to share this. Lots of times I forget to share the screen, so I just want to check and make sure that I'm sharing the screen. Anyway, oh no, I'm not. I do that every time. All right, well, that's fine. All right, so check this out. It's fine because you didn't miss anything anyway. Here's the Altiverse. UNH is killing us. Healthcare is killing us. UNH and Moderna. Tesla's down a little bit, but other than that, everything looks great. This SYM, we looked it up this morning. They made a deal with Walmart. All right, so here's the LFGY verse. So LFGY is up a point. The average constituent is up 1.2. The only thing down today in this one is CAN, whatever that is. NU, I'm instructed NU is a company that maybe Buffett is in. It's a Brazilian bank or something. Anyway, then there's NVDA, Opera. What's Opera? Who knows what Opera is? Tell me in the comments. That's not the browser company Opera, is it? Surely not. How old is that company? I used to use Opera in like 2002. All right. Well, let's check out the buffer report real quick. Then we're going to get to the subject matter of the video. Index buffers, nothing's really moving. I mean, SPY's only up 4 bips. I mean, NASDAQ's anyway. JEPI's do really well. SVOL and ZVOL look good. Feet looks good. KQQQ, YMAG, 5E pulling back. All right, yield max buffer report. Moderna, Apple, and Tesla pulling back. Coinbase solid. AIYY looking solid. PLTY looking solid. All right, so now we kind of caught up. Let's do this. Here's what I want to do today. We're going to talk back test. Now, I had a request last night in my live stream to show how to use Portfolio Visualizer, and I kind of said I kind of said I don't know, but I'll try to go slow and show just for this one application. So, one of the commenters said, "Well, how about if somebody had, say, 750,000 to retire with, saved up, and they needed an income of 85,000 a year to live off of, So let me show you what I would do with that. And let's make a couple of assumptions. Let's say they're going to use high yield. but they aren't going to use more than 20%. So we'll do some kind of portfolio with some growth and a little bit of high yield, go back about 8 years and see how that would have done. All right, so first thing you have to do is I always set this on month to month. It'll go back automatically to how far the assets that you put in there will go back. So that, but if you want to set it to a specific date, you can. I mean, just to show, well, ours is 2018 because that the first one of the assets I look at starts in like July of 2018. All right, so we'll just measure from them to the present day. But if you want to do something different, initial amount, I usually choose 750, or I mean, I usually choose $1 million, but we're going to type in 750,000. Okay. Now this is if you're still working and saying you're adding 1,000 a month. You know, you could put that in here, but or that maybe you aren't still working. Maybe you're withdrawing 2,000 a month. We could put that in there, and we're going to put in the 80,000 in a second, or we can put in to withdraw a fixed percentage. But in any event, I always put rebalance on monthly, no leverage, reinvest dividends. Yes. Okay. So we need a site. So the person that the scenario is 85,000. What's 85,000 divided by 12? 12, 24, 36. So 6 is 72, 7. So let's do this. We'll do 7,000. That's about what that is. Inflation adjusted, yes, we'll have an inflation adjust. Okay, and then we're going to analyze portfolio. So that's the base model. Then what it'll give you when you do that, you go to Portfolio Visualizer and you go to, this is called portfolio analysis, but then it will give you, it'll give you something like this. We'll say portfolio 1, 2, and 3. Okay, in this case, let's just make this, let's make this simple. It already has 80. We're just going to switch it to 80 SPY and then 20 QYLD. Because we have to use QYLD to go back that far. But so we can check that out and see how that would have done. Now, on the other two portfolios, let's check out something else. Let's check out if we just would have done, let's check out if we would have done 100% SPY, you know, on no growth, but we could have still got the money. We're just going to sell stock. I mean, you're still going to get the income. And then the other one, let's do something like, maybe let's do something kind of crazy like 50-50, like only 50% SPY, 50% QYLD, which would get you a lot of income. That may not be a bad plan for somebody that needs income, because this usually what planners plan on is 4% a year. That's supposedly a realistic amount to take out. So this would be more than 10% a year. So anyway, we'll see. We'll see how it does. All right, so we're going to compare these three plans, portfolio. So that's pretty much all I do is you set it up like I just did. Okay, then you hit analyze portfolios. Okay, and so it goes back to July of 2018. We probably could have gone back further because I didn't put leveraged. Anyway, that's fine. We're going to leave it how it is. July of 18, that's a good time. So SPY and QYLD up 12% total return. Okay, 23% drawdown. That's a pretty low drawdown. So I think that's pretty good. Just SPY by itself had a 23.9% drawdown. The drawdown was only 0.2% more. So the standard deviation of the SPY was 17.5, but the standard deviation of the SPY plus QYLD was lower. That's good. That, I mean, I want low standard deviation. Talk to your own financial planner, but other things being equal, I'd rather have low standard deviation. But the thing is, the all SPY, you returned a little bit more. You made 13.6% total return instead of 12.2. So the question is, are you better to do the option selling one and take a little bit less NAV return, or take more NAV return and just sell a little bit of stock as needed in retirement. And so that's what Portfolio 2 will do. It's still going to pay you the $85,000. It's just going to sell shares of the SPY. Okay, now Portfolio 3, 50-50, because QYLD doesn't pay that much. It just pays 12%. And if you just have 20% of it, you're getting 20% of 12%, which is 2.4%. Now we're getting half of 12%, which is 6%. So this portfolio should make $60,000 the first year. So it will have to sell $15,000 worth of SPY, but that's not that much. This may be a better plan. However, these high yield funds, what do? They aren't perfect. They have drawbacks. And one of the drawbacks is they don't get a lot of upside, especially this one. So now the fact that we're 50-50, we're cutting into our risk asset allocation. We may be better off just to leave it all in risk assets and take the higher NAV return. But anyway, we don't know that yet, but we can go back and look. So this is like this would be like the yield chaser plan down here. One would be probably the wise plan. 1 or 2 would be the so-called wise plan. Probably 2 would be the so-called wise plan. All right, so let's see how 3 did though. Okay, 10.2%. It did the worst, and we would expect that because these things don't have very much upside, so you don't get a lot of NAV return. Okay, that's fine. It did have the lowest drawdown and the lowest standard deviation. So it's in that sense, it's the safest, I guess you could say. So that's interesting. But now, what I always say, the reason we do these things, the return's great. That's part of it. It's the biggest part of it. But the reason we do these things is for the income. So let's just go straight to the income. Okay. Well, this is the portfolio income. Hang on. Okay, that's the income your portfolio generates. It's still, the portfolio is still going to pay you the $80,000. Okay, so Portfolio 1 only generates $14,000 in income. So it's going to have to sell whatever the difference is between that and $85,000 every year. Even Portfolio 3 only generates $23,000 of income. So I want to look back at this. Portfolio 1's 80-20 SPY QYLD. Portfolio 2's just SPY. So of course there's hardly any income. There's a little bit from the SPY dividend, but this one has, I guess it's just 1.5. Okay. Yeah. Okay. Well, none of them generate that much income, but anyway, but they figure the withdrawals into the return. And so just having the SPY, even factoring in having to sell part of it, it was the best plan over the past 8 years. You ended with the most money that way. But that's good to know that according to this, you can have the SPY, all SPY, and just sell stock along the way. All right. So another thing that I think is good to do is hit PDF. If you're planning on, it'll make a real good printout with 3D charts, kind of 3D charts. If you're planning on showing it to your spouse or something, it looks really professional. Or you can just forward the link to their email. All right, so I like this, but I want to do something. I don't trust the data, so I'm going to show you guys how to test something. There's no way that you could make 13% after you withdraw that much money. I don't think they have the money. I put withdraw. Well, okay, yeah, no wonder, because I only withdrew $7,000 a year, not a month. I'm so sorry. But at least you guys are learning how to use this. Okay, withdraw amount. All we have to do is hit analyze portfolios. Now, these results should be a lot lower because when you're taking that kind of cash out of growth assets, you're killing your growth off. I mean, anyway. So, yeah. Okay, so here we go. So the SPY and QILD, you'd be about even over the past, 8 years, 7 years. So good drawdown, good standard deviation, but not a lot of return. Your portfolio is not going to grow when you do that. But some people are fine with just keeping their portfolio even in retirement. I mean, and that's fine too. I mean, or that's a different strategy. This stuff is so important. It's so important. It's really good to get a planner that you trust. Okay, so here's just the SPY alone. You did a little better doing it that way. You made 1.2% NAV return. Drawdown was about the same, and there was a little bit more standard deviation. But that's because the covered call funds do give you some protection and some downside protection and some volatility. They dampen volatility. Okay, so portfolio three, okay, 50-50. Of course, you're really hurting your return here. If you've lost 3%, your drawdown was more than the other ones. So, but let's look a little deeper into this. Okay, well, first of all, let's go down to income. Okay, yeah, income just means the income your portfolio generates, not the income it pays out. But in any event, we'll come back to that. So portfolio one, the 80-20 portfolio, you started with 750, you ended with 720. Portfolio two started with 750, ended with 812. Portfolio three started with 750, ended with 592. Okay, just using just the index, this Vanguard 500 would have done the best out of any of them. It surprises me that would have done, well, it wouldn't have done better than the SPY, but it's a similar type of result to the SPY. I mean, but so the other things I think are interesting on this one are the Sharpe ratio. And the highest Sharpe ratio, well, it looks like the portfolio two, which is all stock. Okay, not making a great case for the covered call funds. Now, remember, this is QILD, and this one particular fund has a weakness that it sells at the money covered calls. So it gets very little upside. But anyway, for what it's worth, yeah, the stock had the best, had the same Sharpe ratio as the index, just having the stock. Okay, well, portfolio growth, not great. Annual returns. Well, yeah, here's the annual returns. This is interesting, I think. This is what you returned. I mean, so you were these plans were returning about the same as the index. This is the buffer report. The index is on the far right. Okay, they were all down between 6 and 7% in 2018, and there was only half a year there. The back half of the year, which was not good, right? Yeah. There was a crash in December of 18, I think. Anyway, all right. Yeah, there was. So, but then you were up the next year, but no one really there's not a lot of alpha. These funds are all underperforming by just a little bit, just because they're withdrawing so much money, or that's the reason. They're underperforming by the amount of money that's coming out. So in any event, okay, so it's portfolio income. It is encouraging on portfolio one, something that I like. The income the portfolio generates goes up over the years, and that does help offset the $7,000 a month that's being paid to you, but also some stock is having to be sold as well. So If you want, I will. I'll share this link with you guys so you guys can mess with it. Let's suggest an alternative though. Let's look at my favorite. My favorite metrics are the upside and downside capture. The index always captures 100 of each. Portfolio 3, which is pretty conservative, catches about 80% of the upside, 85% of the downside. Portfolio 2, which was just all stock, is 100. But the 80-20 portfolio, it is a little safer. You catch about 91% of the upside, but unfortunately, you catch about 93% of the downside. It's saying on here that the perpetual withdrawal rate is 7.9%. Okay, now over here on just the stock, it's saying the perpetual withdrawal rate of this is 8.8%. Well, we're trying to withdraw 10% right now, right? Because we're trying to withdraw. Well, no, we're trying to withdraw 8.5%, I guess, a year. Anyway, and that's why our returns are pretty much flat. I mean, that in witness the returns. So this is kind of a, now here's the problem though. So this was over the past 8 years. If the next 8 years were less bullish, especially maybe if we started off with 2 bad ones at the front or something, and somebody was relying on a plan like this, I mean, it's something to consider. It's another reason why, a planner can really help you out with this. But I like to help where I can. If it was me, here's what I would do. Here's an alternative. I'm going to duplicate the tab and just make a different one. Maybe here's an alternative. Do this. Initial amount. Draw fixed. Cut your spending by 20%. I mean, it's one idea. Do what the government needs to do, or get a part-time job the first 5 years to supplement with or something, because this, I think, is going to make all the difference. I think if you cut about 20% off that, if future growth is important to you, you leave yourself open for low future growth. You don't have a whole lot doing it that way. You have 3 to 5% doing it that way, but you at least have some. But to some people, it's not that important. Some people don't want to leave money to their heirs, or some people don't want to leave a big tax bill to their heirs. Maybe their heirs have enough money and they don't want to. There's all kinds of different reasons. To some people, it's not a priority, but if you retire when you're younger, like a bunch of people, like a lot of people that I talk to do in here, and you're in your 50s or something, it's important not only to living frugal is part of it, but also part of it is getting some growth out of your portfolio, not crushing your whole portfolio. So, but in any event, I like this back test. I think it shows, here's what we could do also, just for fun. Here's what I really like to do is, with using hindsight, let's make a better portfolio. I mean, this isn't realistic at all, but this is I like to do this kind of stuff. So we're going to put we'll put TQQQ in there, and we'll get 20% of that and just 60% of the SPY. And then, okay, so we'll do that and see if that helps out. It may not. I mean, even that may not help out, but so if you do that, then you can make 9.6%. You take more risk though. You have a 41% drawdown and a higher standard deviation. But that's something that people will do, that if your portfolio is on the edge, on the verge, sometimes people will take extra risk. And I'm not suggesting that, but it's just interesting to see what happens. All right, guys, I'm going to see if there's any comments. I just hope I remember to share the screen and everything. I mean, I know I did. I mean, other than off the start. Anyway, I'm just trying to record these things live. Well, let's go back and look at the charts again, see if the market's moving. Hey, how are you doing, Collector's Dream? What do I think of Devo? Yeah, I mean, let's just talk about Devo for a second. Let's go back. Let's go back to this portfolio. I just put triple leverage Qs in. Let's go back and let's take out the QILD and let's put in some Devo. Yeah, Devo's, it's interesting. We'll put in 20% Devo. Now, I don't know if it'll go back as far, but this might be fun. Let's just see if that would have helped us. So we dropped QILD, put in Devo. Oh, heck yeah. Now, this is also the one with leverage with the TQQQ. Let's take that out of there because that's kind of cheating. So if you just had a regular account, 80-20 with a decent amount of high yield, let's see how I would have done. You would have got 4.1%. Not bad, a 27% drawdown. Let's see how much income it would have had. Like I always say, that's the only reason we do these is for the income. Looks like you would have some moderate portfolio growth. You know, a lot of people, that'd be a perfect retirement. Or me, right? I mean, that's one that that would work. Just a flat. That would work. Okay. So on the income, with Devo, you know, it varies. You only made about 10 the first year, but you made more than 20 in 28. Well, 20, that wasn't a full year either. So the first full year, you make more than 20. Then you make a little less than 20 in 2020. Then you make about 20 in 2021. It looks like they're trying to pay, they pay what, 10%. It looks like they're aiming for 10%. Or what am I talking about? 18%. Which is not bad. A lot of funds aim for 12. I mean, so this one could maybe play a part in the $85,000 scenario. Maybe, and that's one more thing to test. Okay, so we're going to go back. So let's do that. Let's go to portfolio 3, which is the one where we're kind of loading up, and let's take out QILD and put in Devo because it pays more. And let's see if that would save portfolio 3. 4.1% for portfolio 1, 4.7, 3.2 for portfolio 3, 24% drawdown. Let's look at the income. There's a little bit of growth in all of the portfolios. The income jumps. The income's pretty nice, you know. You're knocking down about, in 2019 you made about 40,000 and just in Devo dividends. Yeah, so Devo's cool. I mean, heck, I think any of these could work. I said this in Discord today, in the proper allocations. In other words, if they're the really risky ones like YMAX or Alti or whatever, yeah, they can work. You know, maybe 2%. You know, if you're in your overall portfolio, just sprinkle in a little bit for the yield because these things have all kinds of extra risk. That's what I'm trying to show with these tests is how much extra risk you can take on. So anyway, so the conclusion of the last test is over those 8 years, it was better just to sell stock. So like I said, maybe XPay wasn't such a bad idea in the first place because that is an ETF that does that. It just somehow sells stock and they do it in a tax efficient manner. I'm not, you know, that, but it's it's another strategy. You can also buy an annuity and do the same thing when you retire, and you can have money forever. I mean, there's all kinds of strategies. I'm trying to make sure you have money forever, whether it's an insurance strategy, an option strategy, stock strategy. And I love talking about him here. So, I appreciate you guys being here. All right, guys, you have a good day. I'll share those. I'm going to share those back tests, and you guys can mess with them yourself and see what you can come up with. Okay. All right. Have a good one.